Welcome to The Sellouts. I am James Schramm of Schramm Financial Group, a financial advisor and certified exit planning advisor. Here we talk about the good, the bad, and the ugly of selling your business and what it takes to get a deal done. I want to encourage you to like and subscribe this podcast that helps us spread the word and get better guests. Today, we have a great guest, Colin Kent of Premara Group. They are a boutique investment firm that mainly focuses on the middle market and lower middle market of companies trying to help them sell. So, Colin, I want to give you some time to introduce yourself and tell a little bit about your background.
Sure. Thanks for having me. Yeah, my background is a little bit different for most investment bankers. I didn't come up in this world being forced to work 100 hours a week just to see if I could hack it. I came up as an operator, and so I started my career really left Utah, did undergrad at BYU, left Utah, went to San Diego for a bit, started a medical supply company, raised money from a single angel investor there, and then quickly sold out to my business partner. Didn't love that space. We had big insurance contracts that we were able to secure, but dealing with sickness and death, and that world was not for me. And so the opposite of that was high tech. So I moved up to Silicon Valley, worked for Oracle for about 5 years in various sales and leadership roles. And it was a great experience. The people you meet in that market were second to none. They were just a lot of really, really talented people that were in the early stages of their career when I was there. And then I jumped over to Domo, a business intelligence company. I was with them for the same, probably 5 years, and from sub 10 million of revenue up to 100 million of revenue, and through an IPO. And then a fintech company. I had an operating role and was on the executive team at a company called Chargeback. We raised some venture capital while I was there and ended up selling to a strategic acquirer. So have definitely gotten my hands dirty in operating roles. And so we started Premara Group about 5 years ago with this thesis that any deal under about $200 million of enterprise value was generally neglected and just didn't get the attention it deserved. So anything that you mentioned, like on a broker site, it's small, it can be done with loans, sub 10 million, up to about 200 million. We just thought there was a really big gap, especially with operating experience. And that's where we spent most of our time.
No, that's great. So you've had a lot of experience working at some large corporations. Domo was small, but eventually got big. Tell me a little bit of the difference of your experience between Oracle and then Domo, for example.
Yeah, at Oracle, I was employee number 99,494. So for some reason, I remember that. And so, we acquired Sun at that time, Sun Microsystems. Afterwards, we did NetSuite. So really massive acquisitions, adding tens of thousands of employees in some cases. And at Domo, we did contracts on Word documents basically right up until the IPO. So it was just way different. The structure and sometimes the red tape that you dealt with at a big company, you learn a lot through that time, but then you learn, where to spend your time, where to not. And at Domo, we raised so much money. I want to say that we raised around $700 million by the time we went public. And the IPO was very, very underwhelming because, we didn't get out at anywhere near the previous high valuation. Yeah. I think we went out at a $600 million market cap. So it just, the highs and lows with both of those and the structure and lack of structure, it was pretty diverse in both experiences.
So you weren't necessarily on the executive team with Domo, but you were in charge of sales, correct?
Yeah, that's right. I ran a sales team in the Western US, Western Canada. And then my last role there was over a global product, reporting to our chief strategy officer who came from AWS. So that was more of a hybrid sales and marketing overlay.
So how was that getting ready on the sales side? We need to make sure our numbers look as pretty as possible before you IPO. That's kind of that process of selling the stock before it's actually being sold. How was that process?
Yeah, those are back in the days. Like this was probably 2017, 18. And those are the days, though, that as soon as you were almost profitable, you just went and raised more venture capital and tried to grow faster. And so we were growing so quickly, but we were not growing in a capital efficient manner at all. And so top line growth was always interesting. Growing sales teams, trying to add new products that were interesting, and it was very, very. Things were just moving quickly. And in that world of SaaS, your number in a sales leadership standpoint, from that standpoint in sales leadership, your number starts over every single month. And so literally you have a really good month end close and it's like right back to it. So it was just a grind. Whereas Oracle, back then they were setting up everything for their fiscal year end. Like they conditioned buyers to buy software. They were the giant. AWS was just starting to chip away at their database sales.
Yeah.
And that AWS obviously quickly took over. But back at that time at Oracle, everyone was conditioned to buy at the end of May. And so I don't even think you'd get territories and comp plans rolled out until like 2 weeks before the first quarter was over. So, everything was done on an annual basis, and Domo, everything was monthly. And so the pace of innovation and everything just happened faster at Domo.
Yeah, I can only imagine. So what made you go into the investment banking side? I know you were with some startups and things like that, but what made you kind of jump over to the, hey, I want to help companies eventually sell versus starting them up or being part of that growth stage?
Yeah, around the time I transitioned from Domo to Chargeback, I looked at acquiring a couple of different brands, and some were small consumer brands, a couple of small SaaS companies where I looked to partner with VC firms to come in and do an acquisition with me. And I was so underwhelmed by the help that I was able to get from some of these brokers. Like some of them, they sent me financials, but they literally had no idea what these businesses did or how they operated. And so it was super underwhelming. And a mentor friend of mine who ran corp dev at Oracle in the heyday in the early 2000s, he had been doing a boutique investment bank for probably 7, 8 years and some advising roles. And I kind of took this thesis to him and said, "Hey, what are your thoughts? Like this feels like kind of an untapped space, just a whole lot of white space that we could go fill in. And what are your thoughts on that?" And he's like, "Yeah, I agree. I think that that's very true." And so it kind of started like that. And then Josh Robbins, he was a good friend from San Diego days. He and I partnered and basically jumped in together. And, at that time started with a few small consumer brands where we had, operating executive contacts there, sold a few of those to get started, and had a few SaaS companies in mind that we knew would probably go to market. And then it's just started to kind of build a referral network among other professionals. And I think our pitch is very different because we're both operators. Now, Josh came from Amazon and Qualtrics and Lucid Software in Utah, and he had a complementary skill set to me. He's more finance and operations. I'm more sales and marketing, and we were just able to really roll up our sleeves and actually help some of these companies in a real meaningful way.
What do you think it is about Utah where you're at that really breeds these tech, these software type companies and there's just tons of founders of all these different types of tech and software as a service type companies out there in Utah? Why do you think it's, I won't say exclusive to there, but why there's so many?
Yeah, I think that there's a familiarity that exists here where everyone seems to know someone else, and those levels of separation are smaller here than maybe in really big markets.
Yeah.
Certainly in the Bay Area, you had San Francisco at that time was kind of a separate ecosystem than down in Palo Alto, which was different than San Jose, which was different than the East Bay. So there was a lot of disconnection there, and different startups in those different markets operated and had different talent that they were tapping into. And I guess in Utah, I would just say it feels like there's less degrees of separation would probably be the main thing there. And then I think there's been enough people who've done it here or have been involved in some really good exits at some companies where they're happy to go do what I did and sit up, like kind of wait 12 months or go build a product and take time to let it mature before they want to start running.
Yeah.
So, and I think just with the church connections in Utah, you have this DNA of people not being afraid to go sell. Really good product people that can also sell.
I mean,
Really good
if you can
engineers
pedal
that can.
God on the, going door to door, you can pedal anything, right?
Yeah, I think so. There's probably some of that in the DNA of you maybe get that less in other markets, and so I think the fear of rejection may be smaller as well, and there's probably something to that.
Yeah, that's great. So you deal with all different types of owners that have different mentalities, and I know as an investment banker, sometimes you have to kind of coach them through getting ready to sell because this has been their baby for a long time. So tell me a little bit about how you help business owners get mentally prepared to sell their business.
Yeah, I think the advisor part of that equation is, it's super important. You like the fact that we've been in their shoes. When I was at Chargeback, we almost ran out of money. They're like we were trying to raise another round, and you get to that point where you're like, okay, we only have this much runway. When I can say that I've been in that seat, been in the board meetings where you're talking about, okay, what should we do from a strategy standpoint? Should we go raise? Should we go do a little bit different product? Those things all matter, and I think the psychology of it all really does matter, and helping founders see that from the time you say you would like to sell your business to the time you actually have the funds clear and sell the business, you are going to feel every single range of emotion. Every range of emotion. Some days you're going to show up to a due diligence meeting, once we've helped to identify that buyer, and you're going to think, there's no way I should sell this business. Like, things are going so well, and I know we're going to grow by 50% next year, and we're going to be worth more next year. And then another day you're going to show up and say, hey, can we close this transaction a little bit quicker? Because I would give this away for $5 right now if I could. So, every range of emotion, and really understanding the why behind it. Like, yes, money's always a part of it, but there's usually a bigger why, and we try to identify that and help understand why they're going to feel all these emotions and why they're going to worry about their employees. And so all those things matter. Smaller businesses, they tend to matter even more. Bigger businesses, they're maybe a few layers away from every single employee at the company. But if it's a smaller business with less than 40, 50 people, that's essentially been family for
Yeah.
the last number of years.
So what is it? So a lot of business owners, I should say, after they sell, they actually regret it. I think the number is in the 70% range. And there's a lot of different, reasons, whether they didn't feel like they got enough or whatever. But what makes, like, how do you help coach them so that way after they've sold and that they're in the right mentality or the right psychology, that they feel good about their sale?
Yeah, I think part of that goes into the preparation of it all, right? You kind of have to begin with the end in mind. And if you've done it the right way, you've thought about the tax strategies, you've thought about charitable giving, you've thought about all these things you're going to do when that day comes. And if you haven't thought about it much, sometimes we get called in when someone says, "Hey, I've got an offer. It's coming in 2 weeks. Haven't really thought about that. I don't even know if I want to sell to this specific buyer or someone else. Help me think through that," and then we pick up and just start running from there. But yeah, certainly there are so many emotions and things to consider, and I think some people do regret selling if they haven't really thought about what life is going to be like afterwards. Some people are like, "Hey, I've been waiting to go travel for 12 weeks consistently and just be on the road, or I've been waiting for this trip because I just don't know how to unplug." But I think that we can help them see what they want post acquisition as well. Whether they want to step back a little bit and be really deliberate about only doing 20 hours a week, or whether they plan to keep going full go for 2 more years. And there's no wrong answers, and so we sometimes have to help suss some of that out.
Yeah. No, I agree. I was just actually talking to somebody earlier today. She's about to step away from her company. She's been the CEO and president for a long time, and they've already had a liquidity event, but she's stayed on. And she's at the end of the year, she's going to retire. And today, I asked the question, like, what are you going to do? Like, what's your plans? And she's like, honestly, I haven't even really thought about it. And so we had a whole conversation around getting into the right mentality because as I've talked with other people that have sold and clients of ours that yeah, it's fun to go golfing and do some trips, but then after that, what's next? How do you find that fulfillment, or what are your next steps in life to really kind of keep going, especially if you're relatively young. If you're, less than 70 years old, you still have quite a few years ahead of you, and you need to, try to make a plan for that. So how do those conversations go with clients?
Yeah, I mean, I played golf. I saw that you had talked to Alex Bean from Divvy, and I played golf with him 1 week after he sold Divvy, and so everything was still fresh. And so I'm sure everyone is coming out of the woodworks asking for things or congratulating. But I was just like, so what was it like when the money cleared and hit your account? What was the one word you would use to describe it? And he thought about it. He's like, I think it would just be weird. Like, it was weird because all these things you build up in your mind. I mean, as an entrepreneur, I would say that the I don't know, the destination is just the journey, right? Like you get more dividends on the way up than you get at the very end, whatever that outcome is. And so, the biggest thing we can do is help people to see through the other side. You have to be able to picture what life is going to be like. We had a business owner who started a business, bootstrapped after college, was in it for 18 years, sold to a really big strategic. And he was like, I love this. He was maybe 40 years old. He's like, I want to keep doing it for 3 years. I'm fine. I'll sign up for, I can't remember what the percentage was, like 15% of the deal was in an earnout. It's like, I'm fine. I'm going to keep the team in place. I'm going to keep going. He had built a house in Hawaii, and within 4 months, he was like, okay, I just don't think I want to be in this business anymore. So I'm going to give the earnout to the team that's going to stay here. I'm going to take way less of it. I'll still talk to them quarterly or something, but like I'm content, I'm good. And so, and it was a win-win. Like they were able to still make it work because he had a really strong team in place. But we've also seen times where people sold maybe at the wrong time, and they felt that regret that you talked about, where it was, they had more money in their bank account, but they had less meaning in their life, and that's a pretty hard equation to flip like that, especially when it can be so abrupt, because you're never busier um, than the time when you're trying to grow the business and keep it on the rails and go through diligence, and then bam, it sells and everything changes literally the next day.
Yeah. And when you say the timing of it all, you're not talking about trying to time the market or when valuations are the most, but really just kind of the season and time in your life.
Yep. Yeah, I think the time and season for sure matters. I do think it's impossible to time the market. Just like in the stock market, you can note you're never going to time it perfectly. And so I do think just, whether it's your kids are out of the house or whether you're just about to get married and now you want to sell their business. We've seen from beginning to the end, we've done transactions with just about every age of business owner. And, that the part of it that's counterintuitive is that you need to sell the business when it feels like there's still meat on the bone. Like that is, I think, a little bit universal. If you wait to sell the business when you're sick of it, or when there's just too many problems, or you're not willing to deal with those problems, you're never going to maximize the outcome. So you have to do it at a time when you're being thoughtful and you've got some advisors. I always say, talk to other people who've sold too. Like if you don't have anyone in your network who's sold a business, go find someone. Like people will be willing to talk, right? Go find 3 or 4 people in a similar space or in something that's completely different and just get their perspective, because the emotional piece of it is, it's the X factor. The numbers are what they are. Then like we can help tell a story and create a narrative with the numbers, but the core of your business and your team, that's something that it's hard to quantify.
Yeah. And I feel like the sellers can get a set, or sorry, the buyers get a sense that you're desperate. Like when you just want to get out of it, they can feel it and then they'll jump on that opportunity and you're not going to get the best valuation. Versus when you're selling, like you said, when there's some meat on the bones, you're still enjoying it. Like you're, don't have to sell it, but this is a good opportunity for somebody to come in. That's when you're going to get the most bang for your buck, in my opinion.
Yeah, yeah, and I'm sure you've seen that as much as anyone, right? The emotional swings, and they're crazy, and we've seen people who cry 3 times in a week for different reasons because of the emotions, or they're trying to take care of a team member. But I love what we do because we are just, we're in the foxhole with business owners. We're there and we're just hunkered down with them, working through all these challenges and getting to that outcome that's, for most people, it's the most impactful transaction of their entire lives. So we go through that together with them, and you help them navigate the emotions. And it's, there's just so much that goes into it, but when you come out the other side, you're tied together for life. We have clients that we go see on the same time, or every year we try to do things with them to celebrate. We try to help them see that the money is nice, but yeah, like there's so much more that goes into a successful exit. And I think for founders, they, again, that the why, understanding the why, when they know going into it what they plan to get out of it, it's just very different than if they're just like, hey, I think I might want to sell my business, and they haven't given it as much thought. um, so those mission driven type companies, or if they're trying to say, hey, I love what we're doing here and I want to have a bigger impact. And I think I can have a bigger impact underneath this billion-dollar organization. So I want to keep building, but I want to build somewhere else now. And I want to have someone else fund that growth. Those are all good conversations.
Yeah, no, I think those are super important. So you alluded to earlier about somebody that had signed on to with a strategic buyer, and that they were going to do like a 3-year earnout, and then after 4 months they just wanted out. How often do you see it that when, because when you do an earnout, you essentially are giving the company to somebody else, and you are now an employee of them for the most part. Um, how often do you see that those earnouts work out, or that people end up leaving early versus them being able to, be there for the full term of the earnout?
Yeah, you want to be cautious about earnouts just because it's not guaranteed, right? You're signing up to get a new boss for sure. Like someone, no matter what they say, if it's private equity or whether it's a strategic, someone is going to be telling you what to do.
Hmm.
And for some of these folks that have owned a business for 10, 15 years, they're not used to having, they might be used to having a board help to guide what they're doing, but they're not used to having outside influences that don't know the business pretend like they know the business better than them.
Hmm.
And so, we've seen the data. We just pulled this for a client the other day, but the data shows over the last year or so that the percentage of a deal that's based on an earnout has gone down a little bit. So maybe there's some seller financing that comes in to help complete a transaction, or there's just some payment terms, because of interest rates being higher, as we've seen that in the last 12 months. But yeah, we always try to just make sure that from an earnout standpoint, it's not guaranteed. It's just not, and things change. Um, you know, Founders can get pushed out if a buyer doesn't like the vision you have for it. It's within their rights to say, hey, we think someone else can steer this ship a little bit better than you, and that happens. But all we try to do is mitigate that risk and help them quantify what they're signing up for.
Yeah. Especially when the buyer has a slightly different vision of where they want the company to go. I have a good friend. He sold his company, I don't know, 3 or 4 years ago, and he had an earnout for part of his deal. And I think he was supposed to stay on for 2, maybe 3 years. And after, I think it was 8 or 9 months, he's like, it's not worth the money. I'm going to walk away from this extra money, just because he didn't like the new ownership. At first he thought he was going to like him, but then obviously people present, one thing, and then once they own the company, they can do another thing, and it didn't work out. But not that earnouts are all bad, right? You just have to be very careful about who you're getting into business with, because you literally are now signing up, like you said, for a new boss.
Yeah, yeah, and I think that we always try to coach business owners that there is no magic pill or silver bullet. Like we've done several buy side engagements where we're going to help go acquire a competitor for one of our clients. We did one earlier this year, and we know because we jump. If we're going to go vet 40 different acquisition targets and start to have some conversations, a lot of times they get excited because we come in and we're like, hey, our client is not to be named yet, or maybe we've named who the client is, and they think, oh, this company is going to solve all my problems, right? Like they've been in this space for 30 years. They know everything. They're going to solve all my problems. They have the bandwidth. They have more engineers on their staff, whatever it is. And that's almost never the case, right? Like it's good to help business owners and entrepreneurs know that no one knows your business as well as you. They might have a few tricks that would be helpful at some point, but no one's going to care as much as you do, and no one's going to know the details and the nuances of your business like you will. And so we sometimes hear private equity deals where they're wanting to buy 51% of the business and have some upside but share the risk with the entrepreneur, and we don't typically recommend doing that, because just like what you said, it's you're signing up to have a new boss, and you're signing up for someone else's expectations. So we tend to do majority transactions. Or we had a call earlier today with a client, and they're looking to go raise some VC funds. And so we might make a few introductions and say, sure, here are 3 or 4 that align with you. Go talk to them. Go run the business for 12 more months. Let's talk every quarter, and we'll help and provide some operational guidance. But for us, we tend to just kind of want to plant those seeds and help at the very end. And anytime we can help set expectations early on, we tend to set ourselves up for a better outcome, because we're aligned going in, and we're both going in with eyes wide open.
Yeah. Do you see very often, or do you guys do transactions where somebody takes a bite of the apple, right? They take something off the table now, kind of lock in those gains, and but then try to with their strategic partner grow the company to a bigger multiple or a larger value, and then hopefully reap even more rewards. But at the same time, they're able at least to get some equity off the table at the beginning.
Yep. Yeah, we see those from time to time. We went to lunch last week with a friend who runs a family office, and they were executing a roll-up strategy. I forget which industry or sector it was even in, to be honest with you. But the first person, they were doing like 11 deals over a 2-year period. And the first person who decided to roll equity and kind of sign up for this platform play for the next couple of years, I think that first bite of the apple for that person was, I don't know, let's just call it 5 million. And it ended up being a really successful strategy. And the second bite of the apple, which was similar equity to the first, but had grown over time, and the entire portfolio and the valuation of that portfolio had grown to where that person's exit a couple years down the road, and that second bite was like 15 to 20 million. So they took a little bite here, and they were part of a bigger strategy. So yeah, we do see that, and there are times it works phenomenally well. But again, I think that we always just want to caution a founder or a business owner and just help them understand the risk there. But yeah, that second bite of the apple is real and can happen, and we've seen it happen successfully a few times.
Yeah. So going back to the psychology of selling your business, what are typically the best reasons that you see, or that the owner tends to have kind of the best outcome, not even just monetarily, but emotionally when they're looking to sell? Is it, like I said, if you're just going for the pure money, that's one thing, but a lot of times there's a lot more emotions tied to it. So are there any exits or rationale that you've seen that's kind of a common theme, that when they leave the business, they just feel that it's right and it's the right time?
Yeah, I mean, and a lot of times it tends to be that they've either hired an executive team that's generally running the business, and so they're not really in a heavy executional type role at that point. They're less involved in the operations, and so they realize they want to step back for that reasons. And sometimes it might just be personal life. We had an entrepreneur a couple years ago who bootstrapped a company. He raised a little bit of capital, bought out his investors a few years after that, but he'd been going like 21 years. And he didn't know how to take vacations. He didn't know how to take days off. He just worked all the time. And so I think it was the only way he was ever going to pull back from that business was to sell it. Like there was just no other way he was ever going to pull back and spend more time with his family. And I think he had a couple of grandkids at that point. He just wouldn't have.
Mhm.
And then we have one right now that's going on where the business owner just wants to the kids. The business has been, I want to say this one's probably 13, 14 years, but the kids are the priority right now. It's family. It's the business owner has, I want to say, several kids, 5, 6 kids, and it's just not, the business is not the priority of their stage of life. They've had a lot of personal um, family life things that they've dealt with, and so it was finding a good partner. Like they wanted to find a good partner that could help the existing team keep running the business. The business is going to keep going and growing. So that was one. The structure of the deal was the second piece, and then being able to optimize to spend more time with family was the third piece. So that type of transaction doesn't go to the highest bidder. It goes to the right partner,
Mhm.
and it's very deliberate going into it that sometimes the highest bidder is not the right partner.
So do you have business owners kind of list out their reasons for selling? Is there an exercise that you guys do to kind of get them in the right mindset?
Yeah, in the best case scenario, for sure. We typically like to talk to them, or any advisors or other executives that they've got on the team that are going to be involved in the decision, and help to try to identify what those points of potential contention might be in a deal and what they're optimizing for. But it doesn't happen all the time. Don't get me wrong. Like there are plenty of times where it's just opportunistic. Someone says, "Hey, I hadn't really thought about selling this business. When I started it, I didn't start it thinking I would ever sell it, and I just didn't want to work for someone else, and here I am, and now I'm wildly successful, but I just never thought about it. And then we pick up and go from that point forward. And I think everyone is a little bit opportunistic. If they get the right offer and the right structure, sometimes it opens their eyes to thinking, okay, like this might be the time. I hadn't thought about it, but now I'm excited about selling. And you can still, there's no deal that's going to happen and close really quickly. Like a friend of mine in San Francisco, actually, he did, from the time it was a public company that was acquiring his business, and from the time they said we want to acquire you to the time they got the transaction done was like 5 weeks. It was
Wow.
insanely fast.
Yeah.
And that almost never happens. Like that had to happen for a very specific reason for a public earnings call, but that is generally the exception, not the rule.
Yeah. I mean, normally you're looking 90 days is kind of a minimum time frame, at least in my experience. But
Yeah, just for the paperwork side of it,
yeah.
right? Not to, yeah, just yeah. So it can happen, but yeah, I think that the more time, I mean, you want to begin with the end in mind. And so what I always tell entrepreneurs is the most likely acquirer of your business knows who you are already right now. Like that is the most likely acquirer. We can go out and find strategic acquirers and say, hey, we think you should buy this company, and have a thesis as to why it should happen. And sometimes we're right. Most of the time we're wrong, right? Because we might reach out to 200 strategic buyers to find 3 or 4 really relevant conversations and ultimately one buyer. And so if you can begin with the end in mind, and be really patient with creating the right partnerships, finding the right mentors, bringing in the right advisors, making sure your financials are all cleaned up, you're just going to have a less stressful process, and you're probably going to have a better outcome than if you're trying to explain why your numbers are choppy, or if you're trying to explain things throughout the process. It's just not going to be as optimal as otherwise it could be.
Yeah. And I like how you mentioned that a lot of times the best acquirer already knows who you are. I've seen oftentimes people weren't even thinking about selling, and you kind of alluded to this earlier, until they get approached like, hey, we would like to buy you. And then they give an offer. And a lot of times they turn that offer down at first. But what would you say to business owners so we've got a lot of, in my city, I'm in North LA, but also just across the country, that the baby boomers are in their 50s, late 50s, early 60s, and going into 70. And they've got to transition their business, or the business is just going to die with them, right? So
Yeah.
how do we get these business owners to start thinking like, hey, we should start thinking about selling and getting in the right position, because that way you can actually get some value out of this, versus this has just been your baby, and when you're done, you're just going to close the doors and not get anything out of something that you spent 20, 30, 40 years working on.
Yeah. I went to lunch with a business owner who's in that situation a couple of weeks ago, and the business is probably worth $20 million. The guy owns it with his brother. They're both nearing retirement age, and what he said to me is like, "Oh, I don't want to use an advisor to sell my business." And I was like, "Great, like let's talk about what that means and why." And he's like, "Well, yeah, I just don't want to pay any fees." I'm like, "Okay, also fine. But who are you wanting to sell to?" And so as we unpacked it a little bit, I think it was that he wanted to maintain some equity for family members that didn't want to operate in the business, but that he wanted this business and the legacy of the business to continue.
Yeah.
And and so it was a very different reason as we unpacked it. And it's a business that's been in their family for a long time, a couple of generations. And so it's that's you need to understand what you're looking for. It's like, great. If you want to go hire a team and leave the business in place, just great. You have that option. It's running. It's not going anywhere. It's just a services business that's needed in the economy. And it's not going to go away.
Mm-hmm.
But if you want to personally be able to pull away from it, and you want to be able to travel, and you want to unplug from it completely, and get paid up front instead of waiting 5-6 years or whatever it would take to actually get that much money, you just need to understand what the trade-offs are.
Mm-hmm.
And so those conversations are always valuable to be able to have. But like from a boomer situation, I do think that you have to, if you don't have a plan, then you'll see a business start to slowly just fizzle and go away. You see it less often with SaaS companies, right? Because if you're not growing, you will die quickly in software. As soon as churn goes up, the business will start to erode and be done quickly. But for consumer brands and services businesses and other things that might be more stable, it might take a little bit longer. But we see that again and again. Like in different markets, it's a different number. But as soon as a business is doing, 5 million of EBITDA with a single owner, that's usually enough for that person to do whatever they want to do in life,
Yeah.
right? Unless you're thinking you need to go, get to a billion or something. But at 5 million, $10 million, they're just like, I can fly private, I can do all these other things I want to do. And so the business tends to kind of stay right there. They're not investing in growth beyond that horizon. And the opposite of that is true. If you start to pull back and spend less time with the business, and you start to just think that it's going to run forever on its own, a couple of years of decline, all of a sudden that starts to compound, and the business is all of a sudden worth zero when a few years before it was worth a bigger number.
Yeah. I see it in my personal life. So I built up my own financial advising practice, and then I came in and worked with my dad and kind of revamped his practice and then and helped him transition out. But there was a period where he was like, he wasn't working a ton, and because we had all these systems in place and he was more the face and did some meetings here and there, but he wasn't in the day-to-day grind. He was taking a lot more vacations, and it was hard for him to say, I want to sell this now, even though that was kind of the arrangement with me coming in, because he was like, he's living a good life. He's cash flowing super well. Why sell this business? So what would you say to those type of business owners that they have good cash flow? There's no need to sell the business, but they're starting to get older. And you kind of alluded a little bit of not flatlining, but why is it a good time to sell, or what should they be looking for as a better time to sell when they're in that situation?
Yeah, I think it goes back to what I said about needing to sell when things are still going well. The second you have a couple of consecutive years of decline, the business is just worth less. I mean, we see that again in software companies. If you're growing, and the rule of 40 with your growth rate and EBITDA margin being greater than 40, if you're crushing the rule of 40 and you're still growing and you're doing it profitably, you're going to be worth a premium. You
Yeah.
could be worth 8 times revenue or 20 times revenue, or like the one that, last year or a year ago, when in the good times, the frothy times, 100 times revenue. And the opposite is true with that. If as soon as you have a couple of years of decline, you might only be worth less than 1 times revenue. And it happens so quickly. So I would just tell business owners, you either have to go invest in a team that's going to continue to put the time and energy into your business, and that's going to take an investment, right? In your case, I'm sure it took you convincing him and spending money in areas he thought were not needful. And so I think you have to think through those trade-offs. And if you're not thinking through those trade-offs, then all of a sudden you get a couple years down the road and you're like, well, what happened? Like things were great and now they're not. And you have to kind of rebuild from the ground up. So there's no wrong answer. But if you know that you want to pull back more and not necessarily put 50 to 60 hours a week in, and you want to go 10 to 20 and be the face of the company, that's not necessarily a bad thing. But you have to be really careful, because you have an asset that's worth a lot of money, and it can go to zero quicker than you think it might.
Yeah, for sure. And then I've also owners that they think they want to sell. They're starting to go through the process. Maybe even they have an LOI, and then all of a sudden they back out. They get cold feet. They don't want to sell the business. Maybe it's because of the buyer. Maybe it's the valuation. But there's always tends to be some kind of excuse. Have you seen that often?
Yeah, and it can happen, and it can happen for for maybe you're growing too quickly, right? If diligence was taking 90 days and you had a massive new customer, you grew a lot during that period, then you don't think the valuation's fair that you had signed up for previously. And it depends on how it was structured, and if it was based on the trailing 12 or something, or if it was based on projections. And there's always some nuance there, but yeah, we've seen that. And again, the emotions of it, like we do not count our chickens until they're hatched. Like no deal is done until everything's signed and everything's wired. And if you are a seller and you're trying to sell your business, just I would say do not let your guard down. Even if these people have become your friends throughout the process and you know that you're going to feel comfortable working with them, I will just say, if you even stumble a little bit and the business suffers because you were too busy with diligence, that's where we come in. We try to let operators keep doing what adds the most value, which is operating the business, and we take over diligence and we help take a big load off of them. But yeah, just don't take your eye off the ball until those funds are wired, until everything's done. Just don't count on it happening. But the emotions, it can change, and sometimes there's good reasons to say, you know what, I've changed my mind. but we prefer not to get engaged with clients until there's certainty of what they want to do,
Yeah.
because we've seen it. You only have to see it one time. And if you see it one time where you have three founders or four founders and they, a couple of them want to sell and one of them doesn't, like, I don't want to play the role of therapist and have to get in between them and say, okay, well, let's do a pros and a cons list. And why don't you want to sell? You just have to make sure you're getting everyone aligned so that, part of our job is just to make sure we minimize surprises. We want it well scripted and well understood what they're looking for so that when we deliver it, they are all on the same page.
Are there any red flags that you see in owners right away that are talking about selling, but you're like, I don't think you're ready to sell?
Oh yeah. Yes, there are a lot. I mean, we've probably only got a few minutes left here, but there are too many to name. But like we see it all the time. And those red flags tend to just be a disagreement on valuation. That's a huge one. Like if they just, one thinks it's worth 100 million and one thinks they'd sell today for 60 million, like and if they both have equal voting rights or whatever, then you're not going to be able to play middleman and convince them otherwise. I think that if they're still arguing over any details or they're not aligned on what they even want, it's pretty rare these days that someone sells a business and walks away the very next day. There's going to be some transition period. And maybe one founder says, I want to stay in the business for 3 years, and another one wants to be out right away. Like, that happens, and that's okay. You can set that up. But if there's not alignment on what they expect and what they're willing to do throughout the process and the value they bring to that equation, then you've got some work to do before you're ready to actually go do that process and undertake it.
Do you guys ever work with owners that you're just trying to sell ownership of one of the partners and the other partner wants to stay on?
We tend to do that less. From, I would say, that's pretty uncommon for us. And the main reason is just because it can be messy, right?
Yeah.
Like, I guess it can work for some companies if they're going to go do a fundraise or something, and part of the fundraise is going to be used to buy out another partner. That can happen, but we're going to go to market with a client next year potentially that one of the founders is no longer operating in the business. So he still takes a huge amount of the cap table, but he's not contributing anything to the growth.
Yeah.
And so that's hard because now the other founder is shouldering the load that used to be shared between the two of them. And, at the outcome, he's still going to participate the same as everyone else, and still his equity is what it is. And so I would just say it's not impossible. It's just harder. It's just
Yeah.
harder in those scenarios because, again, you've got mismatched expectations. You've got someone thinking one thing, and then maybe their data is delayed by 3 months, and the other person who's in the business thinks it's something else. And so, I would say we do that less.
Well, I appreciate your time. Colin, anything you think we've missed? Any points you would give founders or business owners as they're considering selling?
No, I think we've touched on most of those points, but I would just say that, yeah, it's a highly charged, highly emotional point in time. And so the more you can do to get comfort from an advisor group, from other entrepreneurs who've been through it, they're going to help you see that the problems you're facing are not as big as you think they are. And so we like to play that role. And I think that for me, it's the most rewarding thing, right? In business, it's the most rewarding thing you can do is help someone take this the family members and a team and everything that they're juggling in life and have a successful outcome and see how rewarding it can be for people. And get emails and pictures from past clients just thanking us and saying, hey, like, this has changed my life and I really appreciate you guys. So we love what we do and love working with business owners.
Well, how can our viewers and listeners find out more about you and your company?
Premaragroup.com is our website. Colin Kent for me on LinkedIn, Colin with one L. Happy to connect there. And I am always happy to have a conversation and be helpful, even if it's 5 years ahead of time. I've always found that paying it forward, it pays huge dividends. And I'm always happy to talk to business owners. And I think your podcast, I think it's great. I love that episode with Alex and the candor he had there and just kind of getting behind the curtain of everything that goes into a transaction. It's always fascinating because they're never the same. No two transactions are ever the same, and they all have different curveballs, and they're different for so many reasons. But it's fun because of that.
Yeah, I've found that as I keep interviewing new and different guests from different angles, whether it's the M&A side or venture capital or the actual business owners, no two transactions are the same, right? And they all have different problems, different speed bumps, or just different mentalities, that other people don't go through. So, Colin, appreciate you hopping on and spending some time with us. And I found this valuable, and I look forward to talking to you and working with you in the future.
Great. Thanks for having me.
All right, have a great day. Investment advisory services offered through Raymond James Financial Services Advisors, Inc., Schramm Financial Group, is not a registered broker-dealer and is independent of Raymond James Financial Services. Any opinions of those are of the speaker and not necessarily those of Raymond James. This material is being provided for informational purposes only and is not a complete description, nor is it a recommendation. There is no guarantee that these statements, opinions, or forecasts provided will prove to be correct. Investing involves risk, and you may incur a profit or a loss regardless of strategy selected. Past performance is no guarantee of future results. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Raymond James is not affiliated with any guests on this podcast.